The truth about gold that nobody is telling you, that gold can consolidate for months and months. It can consolidate and correct through the winter and even into the spring. No, we aren't about to see gold go parabolic like 1979 or silver go to 100 the next 3 or 4 months. We are in a correction and consolidation, and not enough people are telling us that. It's Friday, November 7th, 2025, and it's time for your Precious Metals Weekly Recap from the Daily Gold on our official YouTube channel. Thank you so much for tuning in. Let's get right to the charts. This is a big reason why, and I've showed it before, gold against the stock market. The next big move in gold, not just a big move in gold, the next monstrous move in gold will be when this ratio, gold divided by the S&P 500, breaks out above this resistance. But in the last year, we've already seen a sharp sell-off here and another sharp sell-off. We are seeing some stabilization here, and it is above the rising 42-week moving average, which is equal to the 200-day moving average. But this is going to need some time before it can rally back to the red line and actually break through. So that's going to take some time. And this is a big reason why temporarily it's not 1979 and gold is not going to break back out to the upside in 2 or 3 months. But again, stepping further out, 6, 7, 8 months or so, this is the setup for the start of a significant move higher. By setup, I mean when this ratio breakouts to the upside. Okay. Now, let's get back to the here and now. So this is our weekly market overview. These are 2-month daily candle charts, gold, silver, gold against the stock market here. Here we can see the miners here, SILJ here. Here's bonds, the TLT, the stock market. And the end of the week, you did see a bullish hammer in the stock market, and you also saw strong candles in GDX here, GDXJ, also in the silver stocks. So the precious metals have been oversold. In real terms, they came down here to the 50-day moving average, so we are seeing a bounce. And look for the bounce to continue, but I don't think this is a bounce that's going to go back to the highs in the next couple weeks or the next month or two. Here's a chart we have not shown yet. This is our gold correction analog, the gold post-major breakout corrections. I haven't shown this form of the chart, which looks at the overall average, but also an average of 1972 and 1973. Now, the average is looking at 72, 73, and 2006 because those corrections are the most comparable to where we are today. And I think the average of all three works really well. Now, the average of only the two in the early 70s, it makes sense because I've said the 72 correction, we're way overbought and going to correct more than that, which was only 11 or 12%. But the 73 correction, where gold declined 28%, where gold would have to go to 5,800 on the current scale to match it, that's not going to happen. So I like an average of these two. So we have the average of all three, the average of the two in the 70s, and this is what you can see. This is how it plays out. And so you look at how long it could take us to get back to new highs. Here's when things started, mid-October. For both these lines, you're looking at the end of April. So that's about 6 months. Now, something I've mentioned, which we may not necessarily see in these averages, is in these gold corrections, this happened in the 2006 case, you get the price damage right away, and then it rebounds and consolidates, does a retest before it moves back up again. So that is something to keep in mind. If this rally fizzles out and we see more of a sell-off like that, then we could get the price low around here versus if we kind of go sideways like this and then dribble down and make the price low. So those are some scenarios to keep in mind. You have to keep all the realistic scenarios in mind to anticipate what the market could do. Okay, now getting more into the daily candle chart for gold and silver as well down here. So here's gold. We can see here, here's the 200-day moving average. I've sketched in here where it could go. Here is where I think the strongest support is for this move, 3,600, 3,700 right here. That would be almost a 16% correction from the top. Now, we did come down. I think it did a little bit more right here than an 11% decline. So if and when gold goes below this low right here, that sell-off is going to take us that much closer to the price low. But here and now, gold is making an oversold bounce. So it's building a bit of a base here. Here is resistance here. I believe this is, we have higher resistance here at 4,100. So this is, call it 40, 40, 50. So there's a bit of resistance here. It is possible gold could push up here before we see more selling come in and it rolls back lower. With respect to silver, this is an area of strong support, 40 up to just below 42. Now a decline here all the way to just below 42, that would be 24%. That sounds like a lot, but that's exactly the decline we had in 2010 before silver exploded through $20.22, and then it eventually went to $50. And so that correction, where it declined 24% in 2 months, then rebounded for a couple more months, then consolidated for a couple more months, and then exploded, that scenario, I think, is on the table for where we are here now in silver. But very short term, silver has built a bit of a base here. It's come up to this resistance here, call it 49 or so. So again, you could see a pop right here, but I don't think there's enough buyers to sustain it. I could be wrong. On the downside here, again, this low is nearly 17% down. And I think this comes down here to 45 or in the high 44s. So again, wouldn't be surprised if this popped up a little bit before fizzling out. In any case, both these corrections, they need more time. Time and price, people. So here's the weekly chart. We can see here hard selling in gold, hard selling in silver. But look at the last 2 weeks. Better candles. We can see here, these are the strong support levels I'm looking at. So again, we'll see how far these oversold bounces can go before they fizzle out. That will really be the tell. When they fizzle out and we get more selling, do we start to build a really bullish base above this, or do we go lower to a significant price low? Again, keep those scenarios in mind. And keeping all scenarios in mind is something we do in the Daily Gold Premium. And for those of you who have signed up and joined our premium service, I thank you, and thank you for your business. I thank you for your support. Those of you who own juniors and minors and you're looking for some expertise, you're looking to have a stronger portfolio, get into those better companies that still have big upside potential, the Daily Gold Premium is for you. I'm telling you, there's no better value, there's no better service on the market for finding and picking quality gold and silver juniors that have potential to go up 3x, 5x, 7x, even 10x in a spectacular bull market that we could have over the next couple years. So head on over to thedailygold.com/premium. You can join there. It's highly affordable. We'd love to have you join us. And we are focused on picking the best companies that have the most upside potential. And subscribers are responding very positively to the work we do. And if you're not a subscriber, give us a chance. Head on over to thedailygold.com/premium. We'd love to have you join. Now, let's wrap this video up talking about the stocks. And this is really interesting. I have not shown this chart in a month or two. This is the advanced decline line for GDX right here. This is GDX. Now, the advanced decline line, this is a participation indicator. It's a breadth indicator. So every day, this indicator measures how many GDX stocks are rising versus falling. And then you have a cumulative total. So this line is a cumulative total. And so this tends to be a leading indicator. You can see here with all these arrows, there's a leading indicator for GDX. Now, what's happening right now? We aren't seeing a positive divergence yet, but the advanced decline line for GDX, this is holding up really, really well. The miners have corrected 20% or so already. Look at this decline, but look at the advanced decline line. Actually, here's your positive divergence. It's this low right here. We can see this line, GDX is broke well below it. So this is something to keep an eye on. This, even though I like to be conservative and think about downside, if you're short-term bullish and you think this rebound could go farther than I'm thinking, this is your evidence. This is your chart. So this is a sneaky bullish sign in the very short term. Now, stepping back, here we see the silver stocks, SIL here, SILJ. Really hard sell-off in both. We've talked about it. This was a 24% decline in only a couple weeks. This was a 26% decline only a couple weeks. And so what we saw this week, bullish hammer and SILJ. So this decline, these are really oversold. So they're probably going to continue. And we have seen a bit of a bounce in recent days. This will probably continue into next week. Same thing with the gold stocks. And the candles are a little bit stronger. You can see here, these are back-to-back bullish hammers. White candles, back-to-back bullish hammers, and GOEX, same thing here, back-to-back bullish hammers. So overall, big picture correction needs a lot more time, but perhaps most of the price damage in the miners has already been done in the last couple weeks. So that's it for this week. Thank you so much for tuning in. Let me know what you think. Leave a comment. We'd love to hear from you. And hope you have a great weekend ahead. I look forward to talking to you in the next video next week.